What is an IPO? Have you ever wondered what it means when a company goes public? Today we're breaking down everything you need to know about IPOs, initial public offerings, and how they shape the US financial markets. An initial public offering, or IPO, is the process by which a private company offers its shares to the public for the first time. This transformation allows the company to raise capital from investors and become publicly traded on stock exchanges like the New York Stock Exchange or Nasdaq. The primary reason companies go public is to raise capital. By selling shares to the public, businesses can fund operations, expand into new markets, invest in research and development, or pay off debt. An IPO also boosts a company's visibility and credibility. Public companies often enjoy greater media attention, which can attract new customers, partners, and employees. For early investors and founders, an IPO provides an opportunity to monetize their investments. They can sell their shares during or after the IPO, realizing returns on their initial stake. The process begins with selecting an underwriter, usually an investment bank, to guide the company through the IPO. The underwriter helps determine the share price, number of shares to issue, and market strategy. Next, the company files a registration statement with the Securities and Exchange Commission, SEC. This document includes detailed financial information to ensure transparency for potential investors. The roadshow is a critical phase where company leaders meet with institutional investors to generate interest in the offering. Feedback from these meetings helps finalize the share price. Once all preparations are complete, the IPO is priced and trading begins. This marks the company's official debut as a publicly traded entity. Going public provides companies with access to vast amounts of capital that can fuel growth without incurring debt. Publicly traded shares offer liquidity, allowing early investors and employees to sell their holdings more easily. An IPO elevates a company's profile, making it more recognizable to consumers and potential business partners. The IPO process is expensive, involving legal fees, underwriting costs, and marketing expenses that can add up quickly. Public companies must adhere to strict regulatory requirements and disclose sensitive financial information regularly. This level of scrutiny can be challenging for some organizations. Once public, a company's stock price is subject to market forces, which can be unpredictable and impact its valuation significantly. Initially, most IPO shares are allocated to institutional investors like mutual funds and hedge funds. However, retail investors can participate in secondary markets once trading begins. Investing in an IPO offers a chance to get in early on potentially high-growth companies. However, it's crucial to research thoroughly before investing. IPO investments carry risks. Stock prices can be volatile in the early days of trading, so it's essential to evaluate your risk tolerance before diving in. Take Reddit's IPO in March 2024 as an example. Its strong brand presence helped it achieve a remarkable post-launch performance. On the other hand, WeWork's failed IPO highlights how overvaluation or poor governance can derail even highly anticipated offerings. Technology companies continue to dominate the US IPO landscape due to their scalability and innovation. Economic conditions like interest rates and inflation play a significant role in determining whether companies choose to go public. IPOs are more than just financial events. They're milestones that mark a company's evolution. Whether you're an investor or simply curious about markets, understanding how IPOs work is key to navigating today's financial landscape. Thanks for watching. Don't forget to like this video and subscribe for more insights into investing and financial markets.